Every year there are risks with retirement. There are risks with the market going down and correcting. There are risks with inflation. There are risks in being invested into the wrong assets. There are always going to be risks every single year. Now they may change, but there's going to be one risk that's consistent. One risk that we need to be planning for that is going to be there today, tomorrow, and in the future. And that one risk is what we want to be talking about today. Welcome. We have a lot to get to today when we talk about healthcare. You see, one of the primary risks in retirement is outliving your assets. So when we take a look at where you're at today with Social Security, possibly a pension, with assets that you have from your business, from a defined benefit plan that you may have had, defined compensation plans, 401ks, all of these assets that you have been saving up over the years for retirement, now you can utilize, now you can actually be using in retirement to have the experiences, the fun, the joy that you want to have. Well, there's obviously, again, risks that come with retirement, and one of those risks is not having that stream of income coming in every single year from your business or every single year from your company. I'm talking about paychecks. I'm talking about your compensation that you have, all of your equity awards. All of those are basically ongoing on a yearly basis, or sometimes even getting paid out sometimes a couple times a year with respect to some of those equity plans. Well, when you retire, those go away. So what do? Well, we lean back on the other streams of income that we have. So we do have Social Security. You may have that pension, you may have those other streams. Well, that may not be enough. So planning is going to help you determine that. But again, when we come back to that one aspect of planning that is sometimes an unknown, well, how do we deal with the unknowns? Well, we come at it with information. We come at it with the numbers and a plan in place to support what we're trying to do. So let's take a look at this, specifically when it comes to healthcare, because the risk of healthcare is that it's going to be inflated in costs more tomorrow than what it is today, and we're going to have to start outlining more and more money related to healthcare that we had not planned on. Well, again, let's take a look at things just as a big picture. Healthcare is going up in expense. Yes, we are fully aware of that. Take a look at this chart here. We have inflation, we have workers' earnings, and then we have the health insurance premiums. Those are skyrocketing. And even in terms of Medicare, premiums are going up. If you have a supplemental plan or an advantage plan, those premiums are going up. So it could be very actually easy to say that you may be paying $500 a month or more in your own personal premiums. Your spouse may need to be paying $500 and more in personal premiums. All of that is to make sure that you have the correct coverage that you need. Well, when we go and take a look at what's next then for everything related to healthcare, we're starting to say, how can we plan for this? The risk that is there with healthcare? Well, it comes back to how much money do we need today in order to cover the healthcare needs. And when we take a look at things, when we take a look at where healthcare is at, most likely the premiums themselves, we're going to be paying over $400,000 for premiums. And we'll pay over about a couple $100,000 to out-of-pocket costs. And that's for an average couple in retirement. Now, what you're thinking here, $600,000 that I need to be paying out for just medical related healthcare insurance and coverage. That's a lot. That's a huge deal, especially when we have to be paying for a mortgage payment, or we want to go on vacations or do the trips and plans that we want to be doing. That is a lot of money that we need to be outlined. And the answer is yes. But Medicare will take a portion of that. That's a very big piece of the puzzle. So we don't want to remove that from everything. Well, how do we take care of the rest? Well, let me give you one tool, one way that we can be looking at this. Now, there are some limits to this, but if you are still working today, you can put into a health savings account. So let's take a look at that. Let's take a look at the health savings account and why that may be a very good benefit and tool for you. So first of all, let's take out our handy dandy tax sheet here. If you don't have a tax sheet, give me an email. Just reply on LinkedIn or wherever you can get a hold of me, contact me, and I'll be sure to give you a copy of this. Now, what we can do here is actually take a look at the pages here, and it'll talk about what the contribution maximums are on a yearly basis. So for this year, this is for 2022, a family can be putting away up to $7,300. Now, if you're over the age 55, you can also put away an additional $1,000. So it's $8,300 that we can be putting away into an HSA, a health savings account. Now, why is that important? Well, first of all, the money can grow. So we can grow with the stock market. That's going to be very important. The power of compounding. That's going to be very helpful for you in the future. So if we have some years before you're going to need this money, well, we can be putting it into the HSA so that you can be growing it. Well, let's take a look at some other parts of this as well. We can put the money in with tax deductions, so we get a tax break there. Big deal. Second aspect is that it grows tax deferred. So now we're getting two different types of tax savings there. So we have the taxes that we're saving on putting the money into the accounts, the taxes that we're saving on growing the money. See, this is different than if we put money into a brokerage account and just let it grow there, because we pay taxes on it every single year. So when we do it this way, we're avoiding those taxes. Now, what makes this a triple tax threat, meaning that we are going to avoid taxes at the most possible way possible. So we avoid on going in, we avoid on the growth, and the third piece is that we avoid them on the way out, when we take money out of the accounts, the distributions that come out. So we can put money away that is going to grow tax-free and be used for healthcare in the future. So when we take a look at the $600,000, that is a huge amount, yes. But when we start systematically putting money away every single year into a vehicle that does not need to be taxed, well, that makes it all the better. So let's say we can actually start building those accounts up to $50,000, $100,000. Well, that can be used to pay down some of those out-of-pocket expenses. That can be used to pay down some of the premiums in the future. And that's going to cover a portion of what your needs are. Then we, like I said, we talk about Medicare. That's going to be another piece of the puzzle. Most likely that'll cover between 40 to 60% of everything with respect to your outlay. So we're getting close. But if we have, so in this case, we have a couple $100,000, maybe upwards of even $300,000 that's covered from Medicare. We have another $100,000 that would be covered over time from your HSA. Now we're getting really close to having all of your medical and healthcare premiums and out-of-pockets funded for the remaining part of retirement. That will be an incredible place for you to make sure that the number one risk of retirement does not affect you, does not affect your family, and that you can go on being more in line with the joy that you want to have in retirement. So with that, I hope you enjoy this. Please feel free to check out some of our other videos, and I look forward to seeing you next time.